Question 8. How does the BBUS ETF hedge against various market risks? The important thing to understand about the BBUS ETF, JP Morgan Beta Builders US Equity ETF, is that it doesn't actually hedge against various market risks in the traditional sense. Here's why. Passive investment approach. BBUS is a passively managed ETF that tracks the Morningstar US Target Market Exposure Index. This means it holds the underlying stocks in the index in proportion to their weighting, and doesn't employ any active strategies to hedge against market risks. Exposure to market movements. Since BBUS reflects the performance of the underlying index, it will experience similar gains and losses as the overall US stock market. There's no built-in mechanism to protect against market downturns. Diversification as a mitigating factor. While BBUS doesn't actively hedge, its diversification across a basket of U.S. companies helps mitigate some company-specific and sectoral risks. A poor performance by a single company or sector is less likely to significantly impact the overall value of the ETF. Understanding hedge. A hedge typically involves using financial instruments, like options contracts, to offset potential losses in another investment. BBUS doesn't engage in such strategies. Alternatives for hedging. If you're seeking to hedge against potential market downturns, you might consider other investment strategies or asset classes that have a historically negative correlation with the stock market, such as bonds or gold. Who might choose BBUS? BBUS is suitable for investors seeking low-cost exposure to the U.S. stock market. Diversification across a broad range of U.S. companies. A passive investment approach. Question 9. How does the volatility of the BBUS ETF compare to the broader U.S. stock market? The volatility of the BBUS ETF, JP Morgan Beta Builders US Equity ETF, will likely be very similar to the volatility of the broader U.S. stock market, represented by its underlying index, the Morningstar US Target Market Exposure Index. Here's a breakdown of the reasons why. Passive tracking. BBUS passively tracks the target index, meaning it holds the same basket of stocks in the same proportions. As a result, the price movements of BBUS will closely mirror the price movements of the index. Market cap weighting. The target index uses market cap weighting, where larger companies have a greater influence on the index performance. Since the U.S. stock market is dominated by large-cap companies, BBUS will essentially reflect the volatility of these larger companies. Limited diversification effect. While BBUS offers diversification across various companies, it primarily focuses on large and mid-cap U.S. equities. This limits its ability to significantly reduce volatility compared to the broader market, especially when large-cap stocks are the primary drivers of market movements. Factors affecting volatility. It's important to remember that the volatility of both BBUS and the broader U.S. stock market can be influenced by various factors, including economic conditions, interest rates, geopolitical events, investor sentiment. Historical comparison. You can compare the historical volatility of BBUS with a broad market index like the S&P 500 using financial data websites or tools. This will give you a practical idea of how closely their volatility tracks each other. Potential exceptions. In rare instances, BBUS might exhibit slightly lower volatility compared to the broader market due to tracking error. Since BBUS doesn't perfectly mirror the index, due to fees and rebalancing, there could be minor deviations in performance. However, this is unlikely to be a significant or consistent difference. Overall, for most investors, the volatility of the BBUS ETF can be considered practically equivalent to the volatility of the broader U.S. stock market. Question 10. What are the potential consequences of a major decline in the U.S. stock market for the BBUS ETF? In the event of a major decline in the U.S. stock market, the BBUS ETF, J.P. Morgan Beta Builders U.S. Equity ETF, would likely experience significant negative consequences due to its inherent characteristics. Direct reflection of market downturn. BBUS tracks the Morningstar U.S. Target Market Exposure Index, which is heavily influenced by the performance of large and mid-cap U.S. companies. If these companies experience a decline in stock price due to a broad market downturn, the value of BBUS will also suffer. Magnitude of losses. The severity of the losses in BBUS would depend on the extent of the decline in the U.S. stock market. A deeper and more prolonged market downturn would likely translate to larger losses for BBUS. Limited downside protection. Unlike some actively managed funds that might employ hedging strategies, BBUS doesn't actively hedge against market downturns. This means it's fully exposed to the negative movements within the U.S. stock market. Potential for portfolio impact. If BBUS forms a significant portion of an investor's portfolio, a major market decline could have a substantial negative impact on their overall investment returns. Investor considerations. Investors holding BBUS during a major market decline should maintain a long-term perspective. Historically, the U.S. stock market has recovered from past downturns. Investors with a long-term investment horizon might choose to ride out the volatility. Reassess risk tolerance. A significant market decline can be emotionally challenging. Investors should reevaluate their risk tolerance and consider portfolio adjustments if needed. Seek professional advice. Consulting a financial advisor can be helpful in navigating a market downturn and developing a suitable investment strategy. Additional considerations. Diversification. While BBUS offers diversification across companies, it remains concentrated in the U.S. market. Investors seeking broader diversification might consider including assets with a historically negative correlation to stocks, such as bonds or gold, in their portfolios. Dollar cost averaging. Investors with a long-term investment horizon might consider using dollar cost averaging to invest in BBUS throughout the market cycle. This approach can help reduce the impact of buying at a market peak. Question 11. How does the BBUS ETF's portfolio composition compare to other U.S. equity ETFs? The portfolio composition of the BBUS ETF, J.P. Morgan Beta Builders U.S. Equity ETF, can be compared to other U.S. equity ETFs along several key dimensions. Underlying index. BBUS tracks the Morningstar U.S. Target Market Exposure Index. This index focuses on large and mid-cap U.S. companies, but might not include smaller companies. Other U.S. equity ETFs, the underlying index can vary significantly. Some popular options include SPDR SP 500 ETF, VOO, tracks the SP 500 index, representing the 500 largest publicly traded companies in the U.S. Vanguard Total Stock Market ETF, VTI, tracks the CRSP U.S. Total Stock Market Index, offering exposure to a much broader universe of U.S. companies, including small-cap stocks. iShares Russell 1000 Growth ETF, IWG, tracks the Russell 1000 Growth Index, focusing on large-cap growth companies in the U.S. Sector weighting. BBUS. The weightings will reflect the sector distribution within the Morningstar U.S. Target Market Exposure Index. Large-cap companies tend to be concentrated in certain sectors like technology, financials, and healthcare. Other U.S. equity ETFs, sector weighting can differ based on the underlying index. For example, an ETF focused on technology stocks will have a higher weighting in the technology sector compared to BBUS. Investment style. BBUS, passively managed, aiming to mirror the performance of the underlying index. Other U.S. equity ETFs, management style can vary. Some are passively managed like BBUS, while others are actively managed, where the fund manager attempts to outperform the market by selecting specific stocks. Question 12. What are some alternative U.S. equity ETFs that offer similar exposure but with different characteristics? Since the BBUS ETF, J.P. Morgan Beta Builders U.S. Equity ETF focuses on broad market exposure with a passive management style and large-cap company emphasis, here are some alternative U.S. equity ETFs with similar exposure but some key differentiating characteristics. Similar exposure, different underlying index. Vanguard Total Stock Market ETF, VTI, tracks the CRSP U.S. Total Stock Market Index, offering a broader U.S. market representation compared to BBUS. VTI includes large, mid, and small-cap companies, providing more diversified exposure across the entire market capitalization spectrum. While both offer broad exposure, VTI might experience slightly higher volatility due to the inclusion of smaller, more volatile companies. Similar exposure, lower expense ratio. Schwab U.S. Broad Market ETF, SCHB, tracks the Dow Jones U.S. Broad Stock Market Index, offering exposure to a wide range of U.S. companies similar to BBUS. However, SCHB boasts an even lower expense ratio than BBUS, potentially leading to slightly higher returns over the long term due to lower fees. Similar exposure, actively managed. Fidelity 500 Index Fund, FXAIX, while not technically an ETF, it's a mutual fund. FXAIX offers actively managed exposure to the SP 500 index. This means a fund manager attempts to outperform the SP 500 by potentially making strategic adjustments to the holdings within the fund. However, FXAIX comes with a higher expense ratio compared to BBUS, and there's no guarantee of outperformance compared to the passively managed BBUS. Similar large-cap focus, different index. SPDR SP 500 ETF, DOO, tracks the SP 500 index, which represents the 500 largest publicly traded companies in the U.S. DOO offers a more concentrated large-cap exposure compared to BBUS, which might include some mid-cap companies as well. DOO might experience slightly lower volatility due to its focus on established large-cap companies. Question 13. How do the expense ratios and risk profiles of these alternative ETFs compare to the BBUS ETF? Expense ratio analysis. BBUS boasts the lowest expense ratio, 0.02%, among the options listed. SCHB follows closely with an expense ratio of 0.009%, making it another very cost-effective option. VTI and FXAIX have slightly higher expense ratios, 0.03% and 0.025%, respectively. While the difference might seem small, it can accumulate over time, impacting your overall returns. Risk profile analysis. All these ETFs offer generally moderate risk profiles due to their focus on U.S. equities. BBUS and VOO have a moderate risk profile because they represent a broad range of companies. However, VTI might experience slightly higher volatility due to the inclusion of smaller, more volatile companies. DOO might have a slightly lower risk profile than BBUS due to its exclusive focus on established large-cap companies. FXAIX, despite being actively managed, still carries moderate risk because it tracks the SP 500 index. However, active management introduces an element of uncertainty as there's no guarantee of outperformance. Consider your priorities. Lowest cost. If expense ratio is your main concern, BBUS or SCHB might be the best choices. Broadest exposure. VTI offers the broadest market exposure across various company sizes. Large cap focus. VOO provides concentrated exposure to large cap companies for potentially lower volatility. Active management. FXAIX offers the possibility of outperformance, but with higher fees and no guarantees. Question 14. Could an actively managed U.S. equity mutual fund potentially outperform the BBUS ETF? Yes, an actively managed U.S. equity mutual fund could potentially outperform the BBUS ETF, JP Morgan Beta Builders U.S. Equity ETF. However, there are important factors to consider. BBUS ETF characteristics. Passively managed, BBUS tracks a specific index, aiming to mirror its performance. Low expense ratio. With a 0.02% expense ratio, BBUS offers a very cost-effective way to gain exposure to the U.S. stock market. Actively managed mutual funds. Investment strategy. These funds employ professional fund managers who actively research and select stocks based on their analysis and market outlook. The goal is to outperform a benchmark index like the SP 500. Potential for outperformance. Skillful management. If the fund manager has superior stock selection abilities and can consistently identify undervalued or high-growth potential companies, the fund might outperform the broader market reflected by BBUS. Market timing. In some market conditions, active managers might strategically adjust the fund's holdings to capitalize on specific opportunities, potentially leading to better returns than a passively managed ETF. Challenges of outperformance. Market efficiency. The U.S. stock market is generally considered semi-strong or efficient. This means that publicly available information is already reflected in stock prices, making it difficult for active managers to consistently outperform the market. Fees and expenses. Actively managed mutual funds typically have higher expense ratios, often ranging from 0.50% to 1.50%, compared to BBUS. These fees can eat into potential returns and make it harder to outperform a low-cost ETF. Performance persistence. Past performance is not necessarily indicative of future results. Just because a fund has outperformed in the past doesn't guarantee it will continue to do so. Important considerations. Actively managed funds have a higher risk of underperformance compared to a passively managed ETF like BBUS. The fund manager's decisions might not always pay off, leading to returns lower than the market. Carefully research actively managed funds. Evaluate the fund's track record, investment philosophy, management team experience, and expense ratio before investing. Alright folks, that's all the time we have for the BBUS ETF today on Chat ETF. There are alternative ETFs like VTI that offer broader exposure, or SCHB, with an even lower expense ratio. Actively managed funds like FXAIX present the possibility of higher returns, but come with increased fees and no guarantee of outperformance. The choice ultimately depends on your investment goals and risk tolerance. Do your research, consider your options, and don't hesitate to consult a financial advisor for personalized guidance. Remember, here at Chat ETF, we're all about empowering you to make informed investment decisions. So hit that like button if you enjoyed this breakdown of the BBUS ETF, and subscribe for more in-depth ETF analyses coming your way.